Hey, welcome to the 40 Finance channel, everybody. And we have ourselves an epic bear versus bull battle going on right now in the stock market, particularly in the QQQ and the S&P 500. Now, from a QQQ standpoint, I did a video a couple days ago where I was talking about this sort of inflection point that we might be seeing here at the end of earnings. And today is one of those D-days that I mentioned, because today on the 22nd of February is the Nvidia earnings call, and considering where that stands and waiting to the rest of the QQQ, I think it could have a big impact on the market in general. But even beyond Nvidia, we have a couple other inflection points to look at, and to be honest with you, it's been really good watching, really good entertainment. In my opinion, in the stock market, whether you're a bull or a bear, this kind of swirl of which way we're going to go has been pretty exciting. You know, me as a long-term investor and my stance, of course, on the QQQ, I'm going to keep buying throughout this just in small lots, because I think that everything is incredibly unpredictable now. But let's dig into what we're looking at here in the short term. And when I say short term, very specifically, it feels like the next 24 to 48 hours is going to be an interesting ride. And as always, we're going to be using Seeking Alpha Premium for our charts and data points. If you're interested in learning more about this awesome stock research platform, my affiliate link is in the description. You get a special deal of $99 for a full year. 12 full months of coverage, $99, potentially support my channel as well, which I really appreciate. Check it out in the description. All right, let's start with the QQQ. And the big thing that's going on right now in the Qs is this 200-day moving average. And you see where that sits right now, plus 1.28%. So we are right on the borderline of an up or down movement on the 200-day moving average. And I talked about it on the last video about how it was, kind of exciting that it moved above here this year after what was obviously a tough year last year. But now we are starting to flirt with the opposite direction. And there's a lot of people, particularly the bears, who are out and talking about this huge point where we're setting up for another major downturn in the market. Now, on a similar front, the SPY, or the S&P 500, is flirting with the same level right now, okay? Less than 2% above the 200-day moving average. And with the SPY, things were even a little bit more interesting when it crossed over, because you actually had a point. You see this purple line, which is the 50-day, and then the 200-day, the 50-day jumped over. So if you rely only on technical charts right now, the S&P had gotten itself into a really good spot here in 2023. Now some of that is at risk of going away or dipping to the other direction. And just like the QQQ, the bears are out big time right now, and they're talking about this event as the setup for the next big downturn. Okay, flipping over to Twitter real quick, let's take a look at just how bearish some folks are right now. And I think it's very, very interesting. So you take this, sorry, I didn't call this person out. Reformed Trader, do not know them, just a person that I follow on Twitter. And look at the chart that they drew up. Look at their, give or take projection, right? This is what they're calling for. And they go on to compare it to this chart, just sort of the phases chart that we've all seen in the market. And this is what they're saying we're in right now, is this bull trap. The bounce for return to normal is kind of how we've started off 2023. And again, the insinuation here is we go all the way down before returning to the mean. So at least in this person's opinion, to be fair, this could happen. You just never know. I don't personally see it that way, but that's exactly what they're drawing here and their expectation of where the market is going. Now, just to share a bullish view from Tom Lee, who's on CNBC all the time, and if you're bullish or you're struggling to find positive news in the stock market, I definitely encourage you to follow Tom Lee or look up some of his videos. He's one of the few people who sits at the desk and pounds bullish during, not only last year, but into this year as well. And Tom came out this morning with his review of the FOMC minutes that were released. And some of this is old news, but they've actually released the written notes of what the Fed talked about in their meeting. So people like Tom and plenty of other analysts kind of comb through the notes and look for little nuggets. And here's what he has. Call out meeting was before January economic inflation data, which was stronger than October to December trend. Fed is becoming data dependent while markets are becoming data reactive, in Tom's opinion. The need for Powell to go full Volcker has passed as inflation is cooling, and that decline isn't a straight line down. Then he goes on to say it might surprise many that even under Volcker, equities delivered their best return under any Fed chair. He shares this chart. So Paul Volcker was in office from 79 to 87, and the nominal CAGR was 15% when the real one was 9%. So again, it's another view of what could possibly happen, even if we get what many would think would be bad news, which is continued interest rate hikes. And he goes on to say it's a misconception to argue stocks need to fall because the Fed is hiking. Powell is not trying to shock markets, but is becoming predictable. Why does this mean equities need to fall 20%? And to me, I think that's an argument that at least resonates in my brain, is just this whole game of interest rates are up, stock market must crash. And that's not to say that the two aren't related, but I do think like this information age with social media and whatever, like people are hanging on the interest rates on a life or death scenario. And at least in my opinion, I follow all the movements. I'm always interested to hear what Jerome Powell has to say. But we also have to move on to some degree and look at what companies are actually doing. All right, continuing on, since 1970, there have been 14 tightening cycles over 12 months. 11 of 14 were data dependent, and stocks went up. During Greenspan, 5 of 5 cycles saw higher stocks. Exceptions were Burns and 22 with Powell. We expect markets to see the Fed as predictable, aka data dependent. Economy is resilient and so far absorbing hikes. Rates will be increasingly restrictive as inflation continues to fall, so Fed can be predictable, meaning a Fed more like the Greenspan era. And to go back on that, with the Greenspan era, 5 of 5 interest rate tightening cycles saw higher stocks during that time. All right, so all that stuff's on the macro side of what's going on with the market. On the micro side, or the single stock side, we've got Nvidia today. I don't own any standalone Nvidia stock. However, it's a big piece of my QQQ puzzle. So I will be rooting for them to have a great earnings, and probably more importantly is to at least have some upbeat news on the year ahead, at least as it relates to last year's performance. And the reason that this is so big right now, Nvidia at $207 is really running ahead of its own valuation. All right, so it has a lot of positives priced into it right now. If you look at the non-GAAP forward PE, which is at 63.22, the 5-year average is 42. It's 50% above its 5-year average for forward PE right now. Then you want to go down to, let's just talk sales for a second. You got 18 times forward sales, basically 19. 5-year average is 15, so you're 27% above your price to sales, at least looking forward, right? And then cash flow looking forward, 74 times. They're usually at 42 times on that particular mark. So they are running hot. There's no question about that. They're running hot right now, and that can be fine if they produce an amazing earnings report. All right, here's what we're looking for today. You have EPS estimate sits right now at about 80 cents. That would be for the non-GAAP estimate, which is what they will report in. GAAP estimate is 47 cents. Revenue estimate, $6.2 billion. over the last 90 days. EPS revisions 3 up and 2 down. Now that's for the quarter, EPS revisions for the quarter. If we look at the fiscal year for EPS revisions up and down, you actually have 5 that have come down. So I would say that from a fiscal year perspective anyway, the trend is down, at least from what analysts suspect is going to happen. All right, lastly, let's take a look at the annual estimates from a consensus standpoint. So fiscal period that ends on January 2023. Okay, so this is basically 2022's numbers. They just have a little bit different of an earnings calendar. So through the Christmas season, will they land at 3.27? Okay, that's going to be the question. That is negative 25% growth year over year. Of course, we know what happened in 2021, which was the huge sale of all their chips and graphics cards. The big thing, though, is January 2024, right? This fiscal year that they will provide guidance on. So the forward PE, the forward earnings estimates. Right now, the consensus is 432. Okay, that's across 37 analysts, so it's a pretty good number. It's not just me coming out and saying it. It's got a relatively good average. The span there is 335 on the low end, 545 on the high end. That would be, the consensus number would be 32% growth in EPS, which is exactly what you're looking for on a stock, of course, that is getting a little bit ahead of itself on the valuation. That, if it were confirmed at 432, which hopefully we'll find out today, now you're bringing your forward PE down to 47.84, which is much more in line with, I think, the 45 that we saw on the 5-year average. All right, how about sales? This year's sales, this past year's sales, flat, 0.11%, assuming they do actually hit this number. For next year, getting back into growth, 29.24, not double-digit growth, like I think most of us would hope for out of Nvidia, but you're still right on the borderline, and that could probably sway either way as the year continues on, and I'm sure the majority of that is going to depend on what sort of new products they have and how they see sales materializing as the year goes on. But bottom line, in my opinion, you're going to need to get some sort of confirmation that they're still marching towards this number, right? And ideally, it's going to inch up a little bit more towards plus 10% year over year. And then this number is going to set the standard for a lot of things with Nvidia just to try to justify that valuation right now. I think this is going to be very important, so we'll see what happens with it. All right, guys, so we're riding the line on those 200-day moving averages for QQQ and SPY. Which way do you think it'll go? We also have Nvidia today, which is going to play a role on which way those indexes move, up or down. And quite honestly, you got a coin flip on opinions. You have a lot of people who are super excited to see things go under the 200-day and just keep going to levels that we did not even see in the meltdown that we had last year. And then on the flip side, you have some other people who are saying things aren't as bad as you think. Now for me, I am underwater on my QQQ shares, about $350 cost basis. So I'm going to keep buying my 1 share a week, 2 shares every other week, stuff like that, just plugging away and lowering my cost basis because it's easy for me. It's a long-term hold. All right, before you go, don't forget to check out that Seeking Alpha special offer down in the comments. Potentially support my channel as well. Hope everybody's doing well. Hope you are enjoying watching this crazy, crazy market and the tug of war between the bulls and the bears. We'll see you on the next video.